In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about Zomato's latest quarterly results and what it tells us about India's food delivery as well as India's quick commerce market. In the second story, I'll talk about how silver prices have risen to an all-time high recently and what it means really for you and me as investors. And in the third and final story of the day, I'll talk about a latest report by IMF which gives us a great insight on how the world economy is shaping up in front of us. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news in the financial markets in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 24th of October. Let's begin with the first story, which talks about Zomato. Now, Zomato, which was once primarily known as a food delivery platform, has very recently undergone a major shift in its business. Thanks to the rapid rise of Blinkit, which is, by the way, Zomato's quick commerce arm, the company's focus is very rapidly evolving. In fact, some experts now believe that Blinkit could end up becoming more valuable to Zomato than its core food delivery business, which is a major change from just 1 year ago. Now, the reason why I'm talking about this today is because Zomato very recently released its financial results for the second quarter of FY 2025. Their performance reflects its growing strength across different business lines. Zomato's gross order value, or GOV, which is basically the total value of all orders placed on its platforms, grew by a solid 55% compared to the same period last year. Their GOV now became 17,617 crore this quarter. Also, their revenue from operations, or basically in simple words, how much money they made from their business activities, also went up very significantly by about 69% and reached around 4,800 crore rupees. On top of that, Zomato made a net profit of 176 crore rupees in this quarter, which is a huge jump of 389% as compared to the 36 crore rupee profit that they reported in the same quarter last year. Now, this kind of growth shows that Zomato is not just expanding, it is also becoming more and more profitable as time progresses. Now, the thing is, while Zomato's core food delivery business is still going very strong, what is really standing out is Blinkit. This quarter, Blinkit GOV grew by a stunning 122% year over year, and it reached about 6,100 crore rupees. The company has also very aggressively been expanding, and they have added about 152 new dark stores and 7 warehouses in just this quarter alone. This brings the total number of Blinkit's dark stores to 791. To give you a comparison, when it comes to scale, Blinkit is a lot ahead of its competitors. Swiggy's Instamart, for instance, has around 600 stores while Zepto operates around 500 of them. Blinkit's larger footprint also gives it a competitive advantage, especially in cities where fast deliveries have become a key factor for consumers. This rapid expansion of Blinkit has even started to impact traditional retail players. For instance, DMart, which is one of India's largest grocery chains, recently noted that online delivery platforms, including the likes of Blinkit, are affecting sales in its metro stores, which normally generate very high revenue per square foot. So basically, this shows just how much the retail landscape is changing, with consumers increasingly opting for the convenience of quick online deliveries. Now, Blinkit's growth is not just about size, it is also about their performance. They saw new stores becoming profitable faster than ever before this time around. Each of these stores is generating about 7 lakh rupees in daily GOV just within the first 3 months. The average value of each order, which in the industry is very popularly known as the average order value or AOV, also rose to 660 rupees, up from 600 rupees in the last quarter. Now, this increase comes from Blinkit offering a wider range of products, including things like electronics as well as beauty items. Now, in comparison, Swiggy's Instamart has an AOV of 450 to 500 rupees, which puts Blinkit much ahead in terms of how much customers are spending per order on the app. Now, geographically speaking, Blinkit has been reducing its dependence on the Delhi NCR region, which earlier used to contribute nearly half of its business. Now, less than 40% of Blinkit's revenues come from this region, and other big cities like Mumbai, Bangalore, etc. are soon catching up. What's even more interesting here is that metro cities like Bombay, Bangalore, etc. are seeing even higher AOVs as compared to Delhi NCR, which is a great sign for Blinkit's future growth plans. But that said, Blinkit CEO Albinder Dhinsa also recently pointed out some seasonal factors that can play a downside on Blinkit's growth. Things like monsoon can slow things down quite a bit, as bad weather tends to affect delivery operations quite a fair bit. But during these periods, Blinkit often sees larger orders as people do prefer to stock up on essentials while it's harder to step out. Now, one thing to note here is that while Blinkit has been grabbing headlines quite a bit as of late, Zomato's core food delivery business is not too behind either. Its GOV grew by 21% year on year and reached about 9,700 crore rupees. This part of Zomato's business has also seen some great improvements in its financial performance. Zomato recently increased its platform fee from 7 rupees to 10 rupees, which has also helped improve its margins. In fact, the contribution margin, which is in simple words the profit that Zomato makes per order, rose to 7.6%, up from 7.3% in the previous quarter. This is especially notable because it shows Zomato's ability to earn more despite ongoing competition and seasonal ups and downs in the food delivery space. Zomato is also gearing up for even bigger things going forward. The company recently announced plans to raise over 8,000 crore rupees through a qualified institutional placement or a QIP. For those who might not know, a QIP is a way for a listed company to raise further capital by selling shares to large institutional investors like mutual funds and insurance companies. Zomato CEO Dipinder Goyal made it very clear that this money will not be used for offering deep discounts to customers, but instead will go towards strengthening Zomato's operations and improving their infrastructure. Dipinder Goyal also explained that even though the business is now generating cash unlike during its IPO, it is very important to have a strong cash reserve given how competitive this industry is becoming going forward. He also emphasized that while money is important, it is not enough on its own. Providing great service is what truly sets a company apart. Also, Zomato is not only relying on quick commerce and food delivery as its future growth plans, it is also expanding to newer areas. After acquiring Paytm Insider, which is a ticket booking platform that I spoke about in one of the stories yesterday, Zomato is getting ready to launch a new app called District. This app will combine dining out as well as ticketing services to offer a one-stop solution for people who want to go out, eat, and also get entertained. According to CEO Dipinder Goyal, this going out segment is growing really quickly, and Zomato is seeing a huge opportunity to bring food and entertainment together under one single platform. The District app is expected to launch just within a few weeks and could become an additional revenue stream for the company very, very soon. So, as Zomato continues to expand and diversify, two very important questions arise for us. First, can Blinkit maintain its growth and profitability while facing increasing competition from Swiggy, Reliance, Flipkart, and others in the quick commerce space? And second, will the new District app become as successful as, let's say, Blinkit has been, or is it a gamble that may not quite pay off for them? Look, only time will tell for sure, but Zomato's bold move suggests that the company is definitely preparing for a future that goes beyond food delivery and quick commerce and aims to be a leader in multiple areas of the fast-growing Indian market. Now let's move on to the second story of the day and talk about silver. Silver recently crossed the 1 lakh rupee per kg mark for the first time ever, and gold hit a record high of 81,000 rupees per 10 grams. Over the last year or so, silver has risen by 17.6% and has outpaced gold's 13.4% increase. But the thing is, silver's journey has not quite been smooth. It has spent some time trading sidewards before this recent surge happened. So the question for today is, what is really driving these moves in silver and gold, and why does it matter to someone like you as an investor? Let's walk through it in this story. First, let's look at the different roles that silver and gold play in the market today. See, gold is seen as the ultimate safe haven asset. Whenever things feel a little uncertain, whether due to economic crisis, inflation, or geopolitical tensions, people and even central banks flock to gold in order to preserve their wealth. It is almost like a security blanket for risk-averse investors and helps them hedge against potential economic trouble. But silver, on the other hand, is a little more complicated. While it is also a precious metal like gold, it plays a very significant role in industrial applications as well. Silver is very critical in many sectors because of its excellent conductivity and makes it essential in electronics, solar panels, and even EVs or electric vehicles. So unlike gold, which is mostly driven by investment and jewelry demand, over half of the world's silver is used in industrial processes. This dual role makes silver behave a little differently from gold as an investor perspective. While both metals tend to move in the same direction during uncertain times, Silver can be a little more unpredictable in comparison to gold. It often does follow gold's lead, but it can take its own sweet time sometimes and even go on its own way due to the industrial demand. Another key difference between these two is how gold benefits from institutional support. See, central banks regularly keep buying gold and add a layer of stability to their price. Silver, on the other hand, does not have that same backing because no central banks are stockpiling on silver. This leaves silver price a little more exposed to shifts in both industrial demand as well as investor sentiments. So, in simple terms, gold is a safer bet, while silver's price is a little more sensitive to whatever is happening both in the financial markets and across industries which use it for production. Now, one very useful way in order to compare gold and silver is by looking at the gold to silver ratio. This ratio tells you how many ounces of silver you need in order to buy 1 ounce of gold. Currently, the ratio is around 80, which means it takes 80 ounces of silver to buy 1 ounce of gold. Now, historically speaking, a high ratio suggests that silver may be a little undervalued relative to gold. At the moment, the ratio is a little high because more people are buying gold as a hedge against geopolitical risks. But if central banks start cutting interest rates, this could change the dynamic and silver might start closing the gap to drive the ratio even lower. So the question then still remains, why exactly has silver's price surged recently? Look, one big reason is the global shift towards renewable energy and advanced technologies. Silver has been in high demand for solar panels, which is a critical component in generating solar power. In 2022, the solar industry alone used about 161 million ounces of silver, and this demand is expected to grow as more efficient solar cells require even more silver. But that's not all. Silver is also very essential for electric vehicles, 5G networks, and high tech electronics, all of which are fast growing sectors. More electric cars on the road mean more demand for charging infrastructure and upgraded power grids, both of which need silver. This expanding industrial demand is a very key factor behind silver's recent price rise. On the supply side, things are not quite keeping up with demand also. In 2023, global silver production fell slightly to 830.5 million ounces. Mining operations have faced challenges from strikes to declining ore quality and even the shutdown of major mines. To give you an example, one of Mexico's largest silver producing mines halted operations recently and put even more strain on global supply. So, this brings us to a critical point. We are currently facing a silver supply deficit. In 2023, demand outpaced supply by about 194 million ounces, which is one of the largest deficits on record. Even though the overall demand dropped by about 7%, mainly because people cut back on buying silver jewelry and coins, industrial demand, particularly from solar panels and electronics, has kept rising. This supply deficit matters because when demand consistently exceeds supply, prices tend to go up for obvious reasons. So while there are still significant silver inventories, these stockpiles are gradually shrinking over time. If this trend continues, we could see a genuine shortage in the market, which could put even more upward pressure on prices. Now, with that said, let's also take a very quick look at what experts are exactly saying about silver's future. Look, UBS suggests that silver often lags behind gold, but eventually catches up, especially when central banks start cutting interest rates. They are predicting that if the US Federal Reserve reduces interest rates, we could see one more surge in silver prices. On the other hand, JP Morgan is a little more cautious in their approach. While they acknowledge the strong industrial demand, they also warn that if global economy slows down, silver might face some serious challenges. A weaker economy will reduce the demand for electronics and solar panels, which could eventually weigh on silver prices. So, looking ahead, most analysts agree that silver will continue to benefit from strong industrial demand, particularly from renewable energy and tech sectors. But it is important to remember that silver's volatility means that we are likely to see some significant price swings along the way. One possible scenario is if the transition to renewable energy speeds up faster than expected, silver demand could skyrocket, which could push prices even higher. But if the global demand slows down, or if technologies reduce the need for silver in key industries, price increases could be more moderate. Interest rates also play a big role, like I mentioned. High rates make holding non yielding assets like silver a little less attractive. But as monetary policy loses and interest rates fall, silver could definitely regain some appeal amongst investors. Now let's move on to the third and the final story of the day, where we talk about the IMF, or the International Monetary Fund's recently released World Economic Outlook for 2024. Look, the reason why I'm talking about this today is because this gives us a very good snapshot of how the global economy is expected to behave. So, if you are an investor, a business owner, or just anyone curious about how economies around the world are doing, this one is definitely for you. See, globally, the economy forecast is expected to grow by about 3.2% in both 2024 and 2025. Now, it's not bad, but it's not spectacular either in a way if you think about it. The good news here is that there is no immediate sign of recession, but that also does not mean that we are completely out of the woods. Beneath that overall growth number, different countries are facing very unique challenges, which is making the picture a little more complicated. Let's start with India to begin with. The IMS projects a strong growth rate of about 6.8% for 2024, and it positions India as one of the fastest growing major economies in the world. This is mainly due to the robust domestic demand, which means people and businesses are spending more, which fuels economic activity. The government's heavy investments in infrastructure like roads, railways, and factories is one more factor over here. These improvements are attracting foreign businesses with schemes like Production Linked Incentive or PLI offering financial rewards to companies which manufacture goods in India. This is making India an increasingly attractive hub for manufacturing. But the thing is, all of this is not without any risks. Inflation, in particular, is rising food prices, which is a key concern. When everyday essentials like food get a little more expensive than they were ever before, consumers have less disposable income, which can eventually slow down spending and, in turn, the economy. India's rural economy, which very heavily relies on agriculture, is also very vulnerable, especially to unpredictable weather like a poor monsoon season that could really hurt crop yields very badly. The banking sector in India is fairly stable right now, but the thing is, if inflation stays high or if global financial conditions tighten, banks could come under some serious amount of pressure. This could lead to a reluctance to issue loans, which could make it even harder for businesses to grow and for consumers to borrow. Now, over to the US next, the outlook is also relatively positive here. The IMF has slightly upgraded its forecast for the US growth, largely driven by strong consumer spending, where people are buying, which is keeping businesses going. The job market over there remains pretty solid, which gives some people confidence to keep spending. But here also there are challenges. Long-term borrowing costs are rising, which are making loans for homes, businesses, as well as investments a little more expensive than they were before. And this could result in a cool-off of areas like housing and business expansion. The US Federal Reserve is trying to strike a delicate balance between controlling inflation and keeping the economy growing, but it's a tough balancing act, so to speak. Next, let's look at Europe, which is not looking as strong as the others. See, the IMF has downgraded its growth forecast for this particular region. High energy costs and sluggish industrial outputs are weighing on the economy. The ongoing war in Ukraine has triggered an energy crisis and especially hurt industries in Germany. Manufacturing is struggling, and while the services sector is doing better, it is not quite enough to offset the hit to manufacturing. Plus, with European central banks raising interest rates in order to fight inflation, borrowing costs for businesses are going up, which are adding a little more strain. Then moving on, let's talk about our neighbor, China. China, like you may already know, was once known for its very rapid growth, but is now expected to slow even further. Its property market, which is a key part of the economy, is in quite some trouble as major developers have been facing high levels of debt. This is leading to less construction and weakening overall economic confidence. The Chinese government is definitely trying very hard to stimulate the economy by investing in infrastructure and offering tax breaks, but with rising debt and cautious consumer spending, these efforts are only having some limited success. Now, the IMF has flagged several risks that could affect this global outlook. I'll give you a very quick rundown. First, geopolitical tensions. See, ongoing conflicts, particularly in places like Ukraine and the Middle East, could disrupt global supply chains very heavily. This could lead to shortages or price spikes in crucial commodities like energy and food. The second one is prolonged tight monetary policies. See, central banks have been raising interest rates in order to tackle inflation. If they keep rates high for too long, it could dampen investment and consumer spending. Europe is already feeling this kind of a problem. They have high borrowing costs, which is making life very difficult for businesses. Next is China's economic slowdown. If China's property market continues to struggle going forward, it could weigh down global growth quite significantly, especially for countries that heavily rely on China for trade. Next is rising protectionism, where countries are becoming more protectionist and introducing policies to limit trade. For instance, the US has imposed restrictions on key sectors like semiconductors. This could slow down global trade and also make it less efficient.
Next is commodity price volatility. Prices for energy and agricultural products could become more and more unpredictable, particularly if geopolitical tensions flare up going forward. A conflict in the Middle East, for example, could really disrupt oil supplies and cause prices to surge, which could impact economies worldwide. Next is labor market disruptions. In advanced economies, labor shortages are pushing wages up without a matching rise in productivity, and this could keep inflation very, very high. In emerging markets, many workers are still in informal jobs, which makes them very vulnerable to economic shocks. The IMF expects inflation to gradually decline, but it is going to take time for sure. In advanced economies, inflation should get closer to central bank targets, but in emerging markets like India, it is likely to stay higher for a bit more time. One of the key challenges is services inflation, which is driven by rising wages and supply chain issues. In countries with weaker currencies, inflation is even harder to control because imported goods become more and more expensive. For central banks, this means they will need to be a little more cautious. Some might also start moving away from aggressive rate hikes to a little more of a neutral stance. But in emerging markets where higher rates have already slowed down investments, there are concerns about long term stagnation if rates do not come down soon. So then the question is, what can you and I as investors expect going forward? See, the IMF predicts that there will be subdued growth in the coming years. Global trade faces challenges from geopolitical tensions and rising protectionism, as I mentioned. The shift from spending on goods to services will definitely continue, but manufacturing, particularly in advanced economies, is likely to face some headwinds. Climate related disruptions are another major risk. Extreme weather events could damage infrastructure and also disrupt supply chains, particularly in regions that are more vulnerable here. So, in short, while today we are not quite headed for an economic crash, the global economy is not also set up for a major upswing either. There are definitely some risks on the horizon, and policymakers will need to tread very carefully in order to avoid stumbling into any of them. This is a time for caution, flexibility, and keeping a very close eye on the factors that could shape the future of global growth. Now, that brings us to the end of the three stories for today. Let's now move on to the final section of the day, which is the small news tidbits. First, Reliance Infrastructure will invest 10,000 crore rupees over the next 1 decade or so to build arms and ammunition manufacturing facility in Maharashtra. It will be called Dhirubhai Ambani Defense City, and it will support India's push for self-reliance in defense production. Second, Air India has expanded its code share with Singapore Airlines. This adds 51 new destinations and boosts its global connectivity to prepare for the Vistara merger. Third, Adani Green Energy's net profit rose 39% year on year to 515 crore rupees in quarter 2 of financial year 2025. This growth came from capacity expansions and better operational efficiency. The company's capacity increased by 34% and drove a 20% rise in energy sales. That's all the news and stories I have for you today. I hope you found this episode valuable and informative. If you have any feedback, suggestions, or absolutely anything to say, please do leave a comment down below and we'd love to read and respond to you. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.